Okay, let's talk about Enphase Energy. You've probably heard of them. They're a huge name in home solar, a real tech innovator. But here's the big question, the one every investor has to ask. Just because a company is great, does that automatically make it a great investment? Well, we're going to put Enphase to the test, and we're using the gold standard, the tough, no-nonsense principles of Warren Buffett himself. So let's dive in.
So, when you hear the name Enphase, what comes to mind? For most people, it's all about the future, right? Cutting edge tech, green energy. It's the kind of company that just feels like a winner. It really does look like a total slam dunk on the surface. But, looks can be deceiving. The real story here is, well, it's a lot more complicated than that.
So what is Enphase's secret sauce? What makes them so special? Well, think of it this way. They basically make the brain for your home solar system. Their big thing is the microinverter, and honestly, it was a total game changer. It's this little device that makes every single solar panel work smarter and harder. What does that mean for you? It means a system that's safer, way more efficient, and just plain more reliable than the old way of doing things. And for a long, long time, nobody could touch them. They were the undisputed kings of the hill.
All right, but this is where we have to pump the brakes on all the exciting tech talk and start looking at the cold, hard numbers. The legendary Warren Buffett has a famous saying. It's something like, it's way better to buy a fantastic company at a good price than a good company at a fantastic price. We've already agreed Enphase is a pretty wonderful company. But the price? What about the price tag? That's where this reality check really kicks in. So to figure that out, we're going to break it down using Buffett's own four-part checklist. First up, the business moat. That's the company's competitive advantage. Second, we normally look at the integrity of the management. Third, we've got to dig into the financials, see if they're strong. And last, but definitely not least, we ask the big one, is the price right? Now for this analysis, the source material didn't really have any issues with Enphase's management, so we're going to set that one aside and focus on the other three, because that's where the real drama is. The moat, the financials, and of course, that price.
Okay, first on the list, the moat. If you're not familiar, a business moat is like the moat around a castle. It's what protects the company and keeps all the competitors out. It's their secret weapon. And for years, man, Enphase's moat looked just impenetrable. It seemed like it was a mile wide and full of crocodiles. And here's why it was so strong. It was really a triple threat. First, you had their amazing tech all locked up with patents. Second, once an installer learned the Enphase system, it was a huge pain to switch to something else. Those are high switching costs. And third, everything just worked together perfectly. Their inverters, their batteries, their software. It was this beautiful, integrated ecosystem. Put all that together, and you've got a recipe for a super loyal customer base. But here's where the story takes a turn. That fortress we just talked about, well, it's starting to show some serious cracks. The premium prices they used to charge, gone. They're in a brutal price war now. And those super loyal installers, they're really struggling because the whole market is in a slump. Suddenly, that huge, strong moat that was their greatest asset, it's being tested like never before. All right, let's switch gears and talk money. We're diving into the financials now, and this is where things get, well, really interesting. If you're expecting a nice, smooth chart going up and to the right, think again. Enphase's financial history looks less like a steady climb and more like a crazy roller coaster. We're talking epic highs and some really stomach-churning drops. And let's start with one of those epic highs. Just look at this number. Nearly 36%. That's their 5-year average return on equity. To put that in perspective, that is insanely good. It's more than double what a super savvy investor like Warren Buffett even hopes to see. This number screams just how profitable they were when the solar market was on fire. This was Enphase firing on all cylinders. And here's another big plus, something that would definitely make Buffett smile. Their balance sheet is rock solid. The company has almost no debt. That's a huge deal. It shows they're careful with their money, and it gives them a massive safety net to fall back on when things get tough. You can't overstate how important that is. But remember that roller coaster I mentioned? Here comes the big drop. Just look at this. It's night and day. Back in 2022, when things were booming, Enphase was a cash-printing machine. We're talking over $700 million in free cash flow. Fast forward to early 2024, and that fire hose of cash has slowed to a trickle, just $41 million, annualized. That is not a small dip, folks. That's a full-on nosedive, and it is a massive red flag for anyone looking at this company. So where did all that cash go? Well, it's directly tied to this. Their profit margins are shrinking. I like to think of it like a pizza. For years, Enphase was getting this huge, satisfying slice, with gross margins up around 40 to 45%. But now, because of those price wars we talked about, their slice of the pizza is getting smaller and smaller. We're down in the mid-30s. Bottom line, for every dollar that comes in, they're getting to keep less of it.
Which brings us to the final showdown, the most important part of this whole thing, the valuation. So let's recap. We've got a great company, but its moat is taking on water, and its financials are all over the place. So the million-dollar question remains, what is this company actually worth? And more importantly, is it on sale? This is where Warren Buffett's ultimate secret weapon comes into play. It's called the margin of safety, and it's such a simple but powerful idea. Think about it like this. If you're buying a house, you get an inspection, right? You want to know what you're really getting into. You want a buffer. The margin of safety is that buffer for investors. It means buying something for significantly less than what you think it's actually worth. It's your protection against being wrong. You simply don't pay full price, ever. Okay, so with all that in mind, where is the margin of safety for Enphase? Well, the short answer is there isn't one. The analysis from our source estimates the company is truly worth somewhere in the range of $85 to $125 a share. And where was the stock trading recently? Right around $119. You see the problem? It's priced at the absolute top end of its value. There's no discount, no buffer, no margin of safety. Period. All right, so we've really put Enphase through the ringer here, right? We've looked at its business, its money situation, and what it costs, all through that tough Buffett lens. So after all that, what's the final verdict? What's the takeaway? I think this one quote from the source material just nails it perfectly. A fair or good company at a full price. Let's break that down. It means, yeah, Enphase is a good business. It's innovative, it's solid, but you're being asked to pay top dollar for it at a time when it's facing some serious challenges like a market slowdown and tons of competition. The price just doesn't seem to reflect the risks. So let's just run down the final scorecard here, the Buffett scorecard. The business moat, it's weakening, definitely showing some leaks. The financials, super volatile and trending the wrong way. And the valuation, that's a hard fail. There is no margin of safety to be found. So if you're looking at this strictly like Warren Buffett would, the conclusion is pretty clear. At this price, the risks just look a lot bigger than the potential rewards. And really, that brings us to the single biggest lesson from this whole deep dive. Enphase is the perfect example of how a truly great, innovative company isn't always a great investment. They're just not the same thing. Right now, at today's price, the math just doesn't work for a value investor. So the question you have to leave with is this: at what price does it become a great investment? Now that is the puzzle every investor has to try and solve.